CNBC TV18 reporters are picking up that India has offered zero tariffs to the US on a range of products, but differences remain on a list of 70 non-tariff barriers. Now, what are the advantages of India is first off the bloc with a deal with the US, but on the other hand, will the non-tariff barriers include a forced currency appreciation? These are the two initial thoughts that come to the mind when one hears of a trade deal, for a preliminary and essentially speculative discussion on the advantages of India being first off the block to strike a deal and the likelihood of currency emerging as a non-tariff issue. I have with me two experts. Sonal Varma of Nomura, who has just written an excellent optimistic report on India looking to benefit from shifting supply chains. And I also have with me Ashhish Vaidya of DBS Bank to tell us what are the currency appreciation fears that are ranging in the market at this point in time. So two very different aspects of the trade deal is what we are discussing. Sonal, Ashhish, thank you very much for joining me. Sonal Varma, an optimistic report from you is very encouraging. At the moment, is Nomura of the view that India is on the winning side of the trade deal?
Yes, and I think the comments from even the US administration seem to suggest that India, along with other allies like UK, South Korea, Japan, are probably going to be first off the block. I think India did start fairly early on the negotiations on the trade front. So, one is hopeful that within the 90-day tariff pause, some sort of a preliminary memorandum of understanding is going to be signed. Now, why is this important? I think from a very short-term perspective, the importance is really in terms of getting some sort of a tariff arbitrage relative to our competitor countries, both in Southeast Asia and other countries in South Asia. The current tariffs on China remain quite high, so there is trade diversion that's ongoing to countries outside China. So if India can negotiate a reciprocal tariff that's lower than where we are right now and lower than our competitor current countries, then we could gain from this trade diversion that's happening from China. This is the immediate impact. More longer term, as the trade deal and India, as India aligns with the US, is really the supply chain relocation theme. Now, shifting supply chains takes time from the firm's perspective as well, but this is more of a medium-term theme that we think will benefit India as well.
If I remembered right, Sonal, Nomura had a sub 6% GDP growth rate for the current year. Are you changing that, or are you changing any of the medium-term growth forecasts?
Yeah, FY26, we are still at 5.8%. I think there are both negatives and positives to take into account for India. The positives really in terms of the trade diversion, the lower oil price that we are seeing, and the more proactive monetary and liquidity easing that we are seeing, which will have some impact, although with a lag. But countering this are the negatives. What we've seen actually is a substantial front-loading of US imports into Q1. So in the first quarter, US real imports were up over 40% on an annualized rate basis, clearly in anticipation of the upcoming tariff. But when you have this kind of front-loading, there will also be payback in the forthcoming quarter. So that's something a number of exporting countries, including India, have to reckon with. And second is the impact really on global demand. There are early signs from the manufacturing PMIs we've got from Asia and outside Asia that demand is softening. There's the impact of uncertainty on investments globally, including on private investments in India. So when we put all of the positives and negatives together, India relatively in Asia actually is still better off. But on an absolute basis, we still think there will be a negative impact in FY26. Medium term, our growth projections for India are around 7%. I think, again, we haven't changed our numbers, but we do think that the impact of the increase in market share that India can gain in the low and mid-tech manufacturing sector will at the margin be a positive.
Okay, that's very good to hear that there is someone speaking about 7%. The best I heard is 6.5% in the medium term. Though, of course, for the current year itself, you would be at the lower end of the range. Ashhish, Vaidya, now for the bigger question that has been roiling currency markets. Earlier this week, we saw Taiwan dollar rise by 12%. And even after the central banker came and said that, currency appreciation is not part of the negotiation, the Taiwan dollar even today is about 10% higher than what it was 1 month ago. Is there a fear that India will be arm twisted into appreciating its currency?
So I think, there is clearly a fear amongst most of the trade partners that they will have to look at currency manipulation in a very constructive manner with the US. But having said that, let me put something in context. So, the early part of the month of April, we saw the dollar depreciate, but mainly vis-a-vis the global currencies, developed market currencies, basically the euro and the JPY, etc. It's actually now in the last few days that it's actually started trickling to the emerging market Asia piece. And I think we are seeing this across the Asia piece. I think that's in line with the trend which we have seen even in the past. Whenever the dollar weakness actually happens, it actually goes first to the DMs and then it trickles to the EMs with the flows actually coming into the EMs. So if actually you start to see constructive flows coming into the EMs, which is both in the debt as well as the equity, that's the time when the trend really sort of gathers pace. And we'll have many more legs in terms of appreciation to the emerging market currencies than what we have seen just now. This is just a small portion of correction that has happened right now. I think if the trend is intact and if the trade negotiations happen in a positive manner, I think we will see emerging market currencies gain considerably.
Okay. No, that is because of the trade advantages that you're talking about, lower tariffs. But is the fear out of the market that, India will be asked to buy 100-year US Treasuries? That conversation was so rife earlier this week. Is that still a nagging fear that of that 70 non-tariff barriers, which are still a matter of disagreement, there could be a currency issue?
No, I think a very good question, Latha. But to my mind, I think the concept of buying long-term treasuries floated by the US administration is mainly diverted towards the NATO currency countries, which are basically where the US administration is saying that we are actually paying for your protection and that's why you need to fund us for long term. That is my understanding of the brief. I think it actually comes
I agree with you,
from that
Ashhish.
angle in the developed markets and basically Europe and other portions which are really using US to defend themselves. It's not going to be the Asia. Asia is going to be more related to the trade and the growth inflation dynamics. And I think clearly the growth inflation dynamics is in favor of Asia.
Okay. Oh, that's good to hear. Though I would also include Japan in your list along with NATO. At least that is the chatter. It's not that I'm privy to anything. But a repeat of the Plaza Accord asking Japan to raise its interest rates or keep its yen higher seems to be part of the chatter. Sonal Varma, anything on currencies that Nomura is worried about, but we don't know enough to write about it. Should we worry that currency appreciation will be part of the negotiation?
So, Latha, I think the non-tariff barrier definition differs across countries, right? So, for countries that run a current account surplus with, in general, so within Asia, that includes Taiwan, South Korea, Japan, Vietnam. I mean, for these countries, China, for these countries, currency could potentially be a part of the negotiation. We don't know entirely what's going on behind the scene. It could be. For countries like India that actually run a current account deficit, the non-tariff barrier again includes many things, but it includes things like quality control orders, for instance, which make it difficult to do business in India. So it is possible for countries outside India, and therefore we need to essentially be prepared for any knock-on effects or spillover effects that happen from a potential appreciation in the broader Asian basket. But is it necessarily an issue for India? I would think there are other non-tariff barriers that we need to deal with. The other thing to keep in mind is the broader dollar weakness that has been going on, initially more against G10 countries. But a lot of these Asian current account surplus countries have been investing in US assets over the last decade and more. And for instance, in Taiwan, the investment by life insurance companies, these have been also unhedged investments. So we are also seeing a bit of repatriation back in Asia, which is also driving this. Not necessarily something that implies directly to India, but indirectly we need to be alert.
Point taken. Out of time, Ashhish, can you just give a range for the currency, dollar rupee?
So for near term, barring any geopolitical stress which we are having with the neighbors, I think broadly in the range of 85 to 83. But I think there are many more legs on the downside in terms of appreciation bias for the rupee over a medium term.
Okay, that's a very important takeaway. Appreciation bias for the rupee, something I don't know if exporters are prepared for. And Sonal Varma saying that a 7% GDP growth on the horizon if supply chains are diverted, and they look like they could be. That's an optimistic conversation, though I still worry about the currency. Thank you very much, Ashhish and Sonal, for joining me. We have to go into a break. Chartbusters coming up after the break.